Good morning, everybody. Welcome to the Flow Show. Here we are, the second week of the new year. I hope you are all doing okay in this early trading period. Morning, Kay. How you doing, mate?
Morning, Ryan. Good morning, everybody. Yeah, I'm doing all right.
Good. Always good to hear. Right, let's get right into it then. No mucking around today. China regulators have apparently lifted or will be lifting the stock net selling ban for mutual funds. This is something they put in place to try and keep stock markets propped up. They're removing this ban for mutual funds, not really because they think everything is a-okay, but this time of year, some of those funds need to pay for redemptions, and to do that, they usually sell stocks, and they're allowed to net sell stocks to pay for these redemptions. So it's a little bit of a mechanical move rather than anything that everything's a-okay in China, but that's what's going on over there. Really not a lot of headlines out today, so it's really been about the data, and this morning we've had some data out of the Eurozone, a few bits and bobs from Germany, factory orders.
Ryan,
yeah,
you are not sharing the screen right now.
Blind. Naughty. There we go.
Oh,
How's
all
that?
right, that's better.
There we go. I forgot to do something this morning. See, not even properly awake yet.
Mhm.
So a bit of data out from Europe. German factory orders coming in soft at 0.3%. We also got some trade data as well, an improvement on the trade balance and a bit of a pickup in activity as well. Up 1.9% on imports, up 3.7% on exports. So that followed some better production data that we saw earlier or late last year in the data as well. So a bit of improvement there for some things, although we know that manufacturing still with a bit of the doldrums over there in Germany. Also out was Swiss CPI, which came in to the upside. CPI coming in at 1.7% versus 1.5 expected and 1.4 previously. The Eurozone measure HICP coming in at 2.1% versus 1.6% previously. Shut that off. So on that measure has gone above the target for the SNB, although the main CPI number hasn't, but a bit of a tick up there. Puts the SNB maybe on a bit more of a hawkish slant, Kay.
Yeah, I mean, as I was saying this morning in the room, that's not going to help us straight away. Those who are looking for a bit weaker Swiss. But the market seems to shrug it off, mostly. We are really waiting to see, and they been delayed or was it wrong in the calendars? I don't know. But tomorrow we will get the we should get the FX reserves out to see if S&B started to either trade both ways, stop the Swiss buying interventions to combat inflation. But yeah, this number is probably putting everything a little bit on a hold. I don't know if we are going to hear. I haven't seen any schedule that any of the Swiss National Bank officials and especially Jordan is to speak soon. I will need to recheck that, but yeah, that could put everything a bit on hold. Swiss is still not really weakening. Yeah, I mean, it's in a bit of a range. We saw those that big demand Swiss in the end at the end of the year. That's been let's say rebalanced a bit, but we haven't been able to see anything or any evidence that Swiss should start to weaken. Especially on Friday, we had this first test of that 85, 50, 60 level, the prior low there that we saw in July, August over the US data, and that was a bit of a failure already. So yeah, Swiss is still one of those currencies that remains relatively strong right now. And on the back of those CPI data, of course, we are not getting new information to reverse anything right now there.
Yeah, thank you very much, mate. Coming back to some of the rest of the data, we had some Eurozone data as well. Investor confidence looking a little bit crappier at minus 15.8 versus minus 15.5 expected, but not as bad as the minus 16.8 previous. Then we got the latest consumer sentiment numbers. Well, these are final numbers, and we got the main economic sentiment numbers out, coming in a little bit better, 96.4, which largely follows the PMIs, where they're still a bit tepid, but some improvements, at least in manufacturing and the likes. Services confidence ticked up. Sentiment there came in at 8.4 versus 5.5. Industrial sentiment still a negative, but a slight improvement. On the inflation numbers, and largely following probably what we saw in the actual CPI numbers last week, consumer inflation expectations rising to 10.5 from 9.3. Selling prices also rising there as well. So that's something the ECB looks at, because they like to see inflation expectations, as they call it, well anchored. But that's picking up in line with, as they've told us, inflation is to be over the next couple of months as well. Retail sales coming in as expected, minus 0.3%. Year on year, not as bad, minus 1.1%. Again, you'd think that, like we've seen elsewhere, retail sales should be pretty bright in November and December, but it's not looking good for November from the whole of the Eurozone. We know German retail sales were pretty atrocious. If that's going to be the same into Q4, or rather into December, thus ending Q4, if those numbers are bad as well, that's going to signal perhaps growth for Q4 is going to come in a bit worse than many expect. Right, I haven't even got it up yet. Look at me, I'm behind again. Let's look at the data from Friday. Obviously, the big jobs numbers that we got out in the US. Bit like the ADP, non-farm payrolls. Where am I? Boom, 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 boom. There we go. Non-farm payrolls beating expectations, 216,000 versus 170k expected. Some of the numbers looked pretty good. Wages came in hotter than expected, 4.1% versus 3.9. We're expected to drop a pip. They actually went up a pip instead, so that keeps some inflationary pressures in the pipe there. Average weekly hours worked dropped a bit to 3.3% as well. So that shows how tight the labour market is over there. Now, we did see the unemployment rate dropping back to, was expected to go at 3.8%, came in at 3.7%, but there was a drop, quite a significant drop in the participation rate to 62.5% there. So overall, looking pretty good on the jobs numbers. No worries, no problems, nothing to look at, although Zero Hedge did their thing and picked out that it was the biggest loss in full-time employment since, I don't know, since the dinosaurs, and the biggest pickup in part-time employment since, whatever came before the dinosaurs, the Big Bang, I think, which you can read into that what you want. It is a funky period. November, December, obviously due to all that seasonal hiring and firing that goes on. So the numbers came out okay. Saw the dollar getting a bit of a lift, yields getting a bit of a lift, and then some of these sour headlines that people picked out of the report saw it turn around. Canadian employment, a little bit meh, I should think. It came in at 0.1k, was expected at 13.5k. The revolving door was in operation between the full-time and part-time, whereas last month part-time was down, this month it was up, and vice versa. For full-time employment, last time it was up, this time it was down. So probably a bit of seasonality in there as well. Again, participation rate dropping back there, leading to the unemployment rate staying unchanged rather than rising by a pip. What were your thoughts on those jobs numbers, Kay?
Well, we traded both sides of the medal, right? Yeah, the headline number on the US, as you say, a bit higher, but then a bit that participation rate coming down, people leaving the market. So the dollar reversed after the initial spike higher. And the Canadian report, as you say, was meh, but then the average hourly wages compensating a little bit. It is a fact, though, that, well, and as we said on Friday, we will have to take both the jobs report and the ISM together, and that's really what the market then did. But as a result, when you come out of it, when you look at where we are this morning, we are roughly back to where we started on some of the currencies. We are left with a bit of a what's next feeling. Well, I am at least. Because we've seen those yields also pop and then drop on the ISM again, and yeah, I mean, there's a bit for both sides. All in all, if you look at it globally, though, I do think that, and it's not. I mean, I'm for sure not a fan of zero hedge, but I saw other people commenting on those multiple people taking multiple jobs, part-time jobs, not being brilliant. I tend to perhaps taking into account that ISM report that we had afterwards, especially when you look at the employment side of things. I tend to look at it rather that side as well, but without really going full gang ho. I want to be short dollars massively. That's not the case either, because the bond market doesn't trade it that way. So why would we? There seems to have been a lot of. It seems the algos are firmly plugged into what the yields are doing as well, and that's what I'm saying. Like, what's next is the feeling, and probably inflation later this week. But yeah, I've got a small bit negative dollar bias, not bias, but feeling perhaps to start the week. But are we going to break any ranges? That's the big question. And for now, if you look at the majors, apart from sterling being quite okay, the rest is rather rangy, right? Very, very rangy.
Yeah, a bit of walking on water or treading water, should we say? But
Mm.
yeah, the ISM was a bit of a counter to the NFP. The headline came in much softer, 50.6 versus 52.6 expected. Obviously, a bigger loss than expected there, but this employment number really did a lot of the damage as well. 43 moving well into contraction, 43.3, especially coming after that fairly decent NFP. So yeah, it seemed to me that although the market sort of went up on the headline number on the NFP and then sold off when people started picking holes in it, it just told me that the market is ready to hit bad news perhaps more than it is good news. So we're likely to see the dollar hit harder on bad news than we are to see it rally on good news.
Yeah,
Just
because that's
because,
what the market is expecting again this year, right?
yeah,
The
exactly. Because
slowdown,
we're playing the cuts. Yeah.
that's what the market expects again, and I guess we are going to see similar as what we saw, especially the second half, perhaps of last year, even though the dollar rallied after July into September, October. But we always said like the market loves to sell dollars, and that's the feeling that we get starting the new year again, right? That the market will love to sell dollars, and any hint at that the situation is going to quiet down or reverse in the States, the market will be eager to sell dollars. Now, it has not really been hammered either, right?
Yeah, I was just about to say it's whatever the sellers are doing, they're finding plenty of buyers coming in, not letting it go too far. So I think we are seeing a much more balanced market at the moment. As we said in the last year, you would have seen, dollar selling really picking up. We saw it in, pairs like dollar yen, all into the latter part of last year. Everything was a rally sell with dollar yen. Now we're just a little bit more balanced, and I think I think once again you've got to take your clues from bonds. I think you've got to be watching really sort of 420, 370 at the moment as a bit of a range for bonds to walk around in. If we don't break out of that sort of range, 370, 420, probably going to see them go sideways, and we're probably likely to see the dollar go sideways. I think maybe one of the dangers for us is a bit of a drop in volatility while we wait to see what these central banks are really going to do and whether it's going to match up to what the markets expect or whether the markets are going to have to match up to what the central banks expect. So yeah, that's going to be my thinking moving forward, just to watch a bit of a range here in yields for guidance for the dollar. Coming on to a couple of the other headlines and bits and bobs. We had Treasury Secretary Yellen out after the jobs numbers, saying yet again that the pessimism on the economy has proven warranted. She's been fighting all those who think the economy is heading to a recession. She says that what we are seeing now can be described as a soft landing, sticking to all things financing. Also, it seems that Congress leaders have hit upon a deal on spending levels for the next part of the can kick to avert a shutdown. This ongoing saga that we come into every couple of months, or it seems like they've got a New Year deal in play to, as I say, kick the can until the next time it comes up. So that should be off the radar for a while. Goldie's has piped up or started piping up on the US election and says that it sees the US election supporting the dollar, and that will offset, and the election will offset rate cuts. So we're going to be starting the campaign trails soon, no doubt. And Goldies think that that's going to be good for the dollar. JP Morgan have decided to bring us some New Year cheer by mentioning the 34 trillion mountain of national debt, and they've called it a boiling frog situation for the US economy. This always rears its head, the size of the national debt and how it's increasing. Nothing's ever done about it. It still remains a bit of a head in the sand for a lot of people in the market. It's just too big a thing to blow up. And so everyone views it that it won't ever blow up because it's too big to blow up. Because if it does blow up, the shit's going to really hit the fan globally. Why do you think JP Morgan are suddenly flagging this up, Kay? Any thoughts?
No, not really. No, because on the other hand, and I think it's the same guys who think that that the treasury market is a good buy again. I don't know. They've got so many teams over there who bring out different reports. No, as you say, it's going to roar its ugly head every few months because the amounts are so staggering. But then, if it's really an issue, and there's going to have to be more borrowing, that's actually going to put upward pressure on yields at some stage, right?
Yeah.
And that's what I'm saying. And another side of JP comes out and say like the treasury market is going to be doing well, and the dollar should be higher on the elections. And I mean, this is the start at the end of the year and the start of the year. Every analyst and his dog wants to bring out some research, which is going to be the theme of 2024, and we're still in that period. And a lot of it is noise, and probably 50% of those who put out contrary views will be right, and the other 50% will be laughed at, and that's probably going to be it, mate. Really.
I remember last New Year's when the banks all brought out their forecasts, and most of them changed them within the first week of the new year.
Yeah, the whole world was going to fall apart.
Exactly, and literally the first week of the new year, they were all revising their forecasts and whatnot.
And they've spent 2023 in revising them all the time, right?
Yeah, exactly.
So well, the one that I thought, and I don't know if you were going to mention it, but the one that I thought interesting that I read over the weekend is the Citi research saying that they would like to trade either Mexican peso or Chinese yuan on the US election. And that I thought was a bit of an interesting take and read, because that could indeed be a couple of currencies that will be impacted by the upcoming US elections, because of the
Yeah,
nearshoring, because of the trade the
yeah,
trade worries, or the geopolitics and all sorts. Those may indeed be two currencies that would be directly impacted by whatever the US election results would be.
yeah. No, I think that's a fairly good point raised from both those currencies,
Yeah.
because yeah, they are going to be directly impacted. You know, if it's Trump, he was all about closing up the borders with Mexico,
Yeah.
so he could get back on that, and then we get to see how he reacts to China. Is he going to be more protectionist, or is he going to open the doors a bit? You know, and the same with Biden, whether he's going to stick to his current guns, or well, whoever's going to be put forward as leader. But the other thing that popped into the headlines was the topic of QT over in the US. This was something that popped up in the Fed minutes, that they may review QT, and Fed's Logan was speaking about it over the weekend, saying that the lack of use, or the declining use of the overnight reverse repo facility, warranted a review about QT. And some people putting forward that if the Fed did stop QT, i.e. stop quantitative tightening, that would ease the pressure on their borrowing this year, which they're still expected to borrow a big chunk to fill some of those black holes that they had in the finances last year. So there's going to be, I think that might be a topic of conversation to come up. Could they really stop reducing the balance sheet, Kay?
Well, I
Just
mean,
to ease
yeah,
liquidity?
that is something that also comes up right now. And I've been talking about this RRP already a few times. And it could have been already liquidity could have been an issue towards the end of year, but it appeared that it has not been at all, because the financial conditions were loosening. Yeah, the RRP levels are something that we should have a look at, because I think they're standing at what, 700 billion or so right now, and the general acceptance is that levels 500 and below there, that would be a little cause for concern. But it's also somewhere logic. If people want to place their money, put their money to work, you're going to see less people piling money into the reserves. Money market funds also have been put some of their money to work back into bonds and stuff, and it's a logic result of QT as well. Now, the Fed, when they did the FOMC, Powell did not really, and I recall we were talking about that. He had a question, and he kind of avoided to answer the question about the RRP and the reserves in relation to QT. So that also told me at that time, and I said it in the room as well. I said, "Oh, there seems to be some antennas going up there as well." So that is something that probably in the first meeting of the year, that question will come back. So the first meeting is on the 31st of this month. I was just looking at my paper. And that is a question that indeed may come back. It's not going to impact markets daily or right now or tomorrow, but it's a question that people will have. And if they indeed start to scale down, which is possible, QT, also I want to remind people that he said that they may continue QT even when they start to lower rates.
Yeah.
But the market has already done that job for them, because they already brought the rates and the expectations down. They may still continue QT, but it may be, if those reserves come lower, it may be at a slower pace indeed. And that it should, in theory, put a little bit more pressure on the yields when the official announcement comes out.
Yeah, thanks, mate. Right, last headline I've got is that we've got banks reporting. I think they're starting this week, reporting for Q4 stuff, and the FT has flagged that there may be a sharp rise in bad loans being reported. Basically, all these interest rate hikes that we've gone through might start to impact some of the activities and banks, and that could crop up in some of the earnings numbers and outlook numbers to come. So that's something to keep an eye on. We know that banks have had a reasonably good last couple of quarters in earnings. Have higher rates started to bite, and will we start to see that in these earning numbers? That's going to be something for stock traders to keep a closer eye on when those start dropping. Kay, you got anything else that's come past your window since last
No,
week?
not really. The only thing, and I usually don't like to talk about them because it's only a part of the market. Yeah, those what is it, COT data or the CFTD or what is it? All those data that people are doing in the futures market and stuff. But it does seem that speculators are still selling dollars, and it appears to me that they may be running into some, as you already mentioned earlier on the show, running into some demand in some areas around some currencies, and I'm thinking like stuff like euro dollar, which is seemingly finding resistance around or close to the 110 for now. Dollar yen finding a bit of bids, trading closer to 145 than 140 in the big scheme, bigger scheme of things. Also, the commodity currency is giving back a little bit. Dollar CAD moving up a little bit. So it seems that they are they're running into some dollar demand, or just people, trading those ranges and on the back of the bond market, not like really wanting to keep dollars short for too long. But no, that's something that I found interesting this time to note that the market is continuing to selling dollars, but with little advance right now. So something that I noticed over the past week or so.
Yeah, thank you very much, mate. Right, well, let's have a look at what's going on in some markets. And as Kay said, it's not an awful lot going on really this morning, particularly. Dollar yen, we've had those wobbles over last week, over the data, over everything going on, and it was up, it was down, and now we're sitting bang in the middle pretty much and not doing an awful lot. Yields have ticked up, as I mentioned. US 10s keeping an eye on, they're still above 4%, which is helping keep a little bit of a bid in the dollar, but it's very quiet in early trading. The market's still looking for clues what it wants to do. Euro dollar, similar picture, up and down on Friday, sitting in the middle, not knowing which way it wants to go. So I don't know what to do here at the moment. Cable, not even really getting the move to any of the sort of upper edges up towards 128s nor down towards 126s, although we did try it on Friday, but came up short of both levels that we've been keeping an eye on recently. So for now, if you're trading these sort of things, you've got to look to see if we're going to be pushing any of these ranges. But while we're in the middle here, if you're scalping, fine, that's probably good enough for you. But for someone like me who likes to sit on a more wider zone, there are some ranges that you perhaps need to wait for your trades a bit more. This one we looked at last week, Aussie dollar. It's had another little test down here again. Friday we saw some decent moves, but now we're a bit quiet. It's respecting the old levels. A bit of a zone here that I had 66, 60s, 80s, holding there, but now we're holding below 67. So a bit of a tightly sprung market, shall we say, in this one. So it could go either way. Oil is one I'm keeping an eye on the early part of this year. I'm going to keep an eye on Brent, actually. just as we're down into this zone here at the moment, down towards 76s. I'm going to be looking a bit closer down towards the 71, 70 area if we get a move down there, because our markets have been pretty weak of late. I think this is something to keep an eye on in the early part of the year. If we get a move down to the sort of 70 zone, 71 zone, as you can see, been pretty weak. And the OPEC bounces have not been very strong at all. We know that manufacturing's in a bit of a slump, so the demand side of the picture isn't helping as well. So that also could be a bit of a driver for FX if we get a breakdown in oil. We know that the OPEC mob are likely to keep it supported.
By the way,
try to keep it supported. Yes, mate.
By the way, the Saudis cut their prices, right? Saudi Aramco cut their prices, $1.50 buck a barrel for their Arab light crude. So that's putting a bit of pressure on the oil again this morning.
Yeah, but they do that quite often, just because there's obviously different prices, different areas, and different countries. But yeah, it all falls into the barrel that oil prices aren't looking like they're bullish or going to turn bullish anytime soon. But so yeah, I'll be looking at support down here. Gold might be just edging down towards a look down again at this 2000 area, shall we call it. We've obviously had a little bit of action prior to that, but now we've just been keeping moving off these highs and that old, what do you call it, quadruple top, if you ignore the spike above this area around 2075. So we may start to get a look, see if we get a test of this 2010, 2000 level, just to see what it wants to do down there. Another one to keep an eye on. So these range plays, I was speaking about this last week. I'm not really interested in getting messing around in the middle, but if we get down to some of the levels that might be worth trading, that's where I'll look to dip in maybe and have a look at that one. Stocks as well, so we'll have a quick look at S&P. Again, looking a bit similar to gold as well, just coming off the highs. This was a bit of a strange one because stocks have gone soggy even while the market turned on Friday, Kay. Maybe they're getting a bit worried about earnings coming up.
Yeah, earnings is one thing, and the other thing, you know, as I said, this probably a give back of what we saw at the end of the year, and I also read that some took profits on their stuff and like somewhere for tax reasons also. That could be why last week was a bit of a down week for stocks as well. Yeah, that low 46s is something that I'm watching as well. See if once this move is done, whether it has more legs to get down, or we just stabilize here and then wait for what's going to happen. You know, we have the US inflation coming up on Thursday, correct? I think so. That's going to be perhaps the big mover. Yeah, the big mover there for the market to take a fresh direction, perhaps. That's the only thing I can see right here and now. Oh, there's a bit of nervosity. There's been nervosity on some of the individual stocks. Like today, for instance, it's Boeing with their grounded 737s that's getting a hit. And it looks as if that is some of those things are dragging the indices a bit lower as well.
Yeah, very much, mate. I was going to have a quick look at the calendar, but there's not a lot in this week. Often after the NFP week, it goes a bit quiet. US CPI is the main headline data we've got this week, and then on Friday we've got PPI, so that will add or subtract from what we get from the CPI numbers. China's CPI is going to be a potentially big one on Friday as well, because another negative number there is expected, which will be 3 months of negative year-on-year numbers, which starts to raise the spectre of deflation in China. And that's going to be something that could be big in the early part of this year if they start to look to cut rates again to combat that. That's going to put some weakening pressure back on dollar China. or rather on the yuan, which will see dollar China rising again. It's already looking a little bit bid at the moment. We have struggled up into this area again, but it's looking more bid, i.e. yuan weakness, than it is strength at the moment. So if we get a soggy number from there, they might be fighting some more fires in not letting the currency weaken too far. But it will bring, as I say, raise the spectre of them cutting rates again and maybe going for a big RRR cut as well, which some of their press have touted too. So lots to still to come in this early part of the year. Okay,
Yep.
got any?
Yeah, and if you're and while you're on China, Ryan, there's one thing that we can't lose out of sight this week is that Taiwan has the elections at the end of the week, and that I mean that may have an impact on the Chinese yuan as well, right? Because there's going to be definitely a reaction in one way or the other on those Taiwanese elections. And that could be in addition to CPI. By the way, it's a big CPI week across the globe, right? We've got Scandinavian, we got Mexican, we got Australia. So the whole planet is seeing CPI data again this week. But yeah, I think keep an eye on what's happening on those Taiwanese elections, because you're not saying it's going to be there's going to be a gap next Monday on the dollar China, but the market may be holding back a bit on the Chinese yuan this week to really take a direction next.
Yeah, whatever happens with the elections and the independent-led or the independent-leaning parties are likely to win again, but we should expect some strong comments out from China after those elections pass about reunifying Taiwan with the mainland. So yeah, expect a reaction. I don't know what it will do for the yuan personally, unless they turn around and say they're going to look to get it back within the next year or so. Yeah, we have to be careful of that one anyway. Okay, over to you, mate.
Okay.
Hello?
Yeah.
You still there?
Yeah. I'm here, mate. I'm here.
Cool. Right.
Just a couple to start the week. And by the way, I'm going to be off tomorrow until Thursday included. I need to do some stuff in my homeland. But this cable is a bit intriguing to me. Okay, we're going up and down with the yields this morning. US yields were a bit higher, and cable came a bit lower. But that level that I was talking about at the end of last week, that 126.10, look at where it stopped on the US data, right there. And I think this is still a pretty decent level to watch in cable going through the rest of this week, perhaps especially on those US inflation data later this week. But it jumped quite fiercely from it. There were levels there in this 127.20 zone. It broke, but then came back. We stopped around those prior highs here that we had end of December. So that's likely to be the decent intermediate level of resistance, 60.75 on the top side. But really, if cable would start to come down again, we really should watch this 126.10, stretch it to the figure or so. But if that starts to break and hold below, then the party for the sterling may be called to a halt. I really think it's still the level to start this week and to watch going further into this week. If we hold again, I think if we start to get back above that 127.20, we may have a revisit of there. But as I was already saying, there's a lot of range trading going on in this market, right? We have seen the similar thing on the Aussie and the Kiwi. Well, the Aussie did not retest the broken trend line, but it held the 38.2 of the end of the year rally around 66.40 on Friday as well. And we didn't even retest the low 66s, but those, I think this zone here will be a relatively decent support zone if ever Aussie comes back into this zone. On the other side, 67 again, it's every time those same levels when you're trading in the broader ranges. We're going to watch 30, 40, 30, 45. But the other one, which is pretty interesting as well, is the Kiwi, because the Kiwi broke the trend line, and that came right to retest it on Friday, around 61.75, that is. And we also see that on the 4 hours, we've got the 200 moving average there. I'm not a big fan of moving averages, but when they come together here with a trend line, it seemed to really have done the job there. So keep an eye on what's happening around this 61.75 area in the Kiwi. Okay, those are those kind of levels that when they pop up and then they saw like a really decent bounce. They're starting to really get important, like a bit in line with what's happening on the cable. So there's just talking about stuff that is going to happen going further this week is the Norwegian kroner. We have CPI as well tomorrow. We know that Norges Bank is selling less Norwegian kroner this month, but oil coming off on the other hand, and looking at being Norway being a big producer, we are back into the first intermediate resistance here around 11.37 on the euro Norway. So we could have a little bit of a push through if oils continue to trade weaker. But then we have to keep an eye on what's happening on that CPI out of Norway, because the Norges Bank did raise interest rates, and they are a little bit, let's say, in between two seats there. And I think the CPI coming out in Norway is going to be quite a driver, because the Norges Bank is going to look at it to see whether they need to keep the rates higher for longer, or actually they are still keeping the door open for another hike, in which case I think there's a case to make for dollar Norway or euro Norway and dollar Norway to have a look a few percent stronger again. If in turn we see a big turnaround in those CPI data, then the market will likely take it a leg higher back into the 1150s, probably on the back of thinking that Norges Bank is finally done with everything. So the Norway is another currency that should be interesting this week. And then one that I'm still having a small position. By the way, I mean, just in general, my positions that I'm having right now at the start of this year, they are not very big right now. It's something, and as I said, we are rebalancing the end of the year flows. I do have a few ideas. I do have a few things that I'm trading, but it's not really, apart from my options in dollar Swiss, which are of, let's say, reasonable size, not even full whack sizes. But my positions are still relatively subdued right now. But here's one that I'm in for as long as we are below this trend line and this traffic zone here, 75.80, and it still looks like the gentle overall trend is to trade a little bit lower. We know that Mexico has kept those yields still as well, though their rates still, and showed less of a pivot or less of a being inclined in bringing them down rapidly. But also we do have the CPI out there tomorrow. So CPI and PPI are there tomorrow. So this I expect it also to move. If we don't see too much changes there, I've got the impression that there's a bit of a gentle slide happening here, which is going to perhaps rest on this 35.40 zone. But if CPI remains sticky, the Mexican peso being, as we know, still an 11% currency, perhaps the carry trade or the Mexican demand can still remain in place, and we may actually have a look back at those lows. But that is for as long as we trade below here. It's a I'm not going to say it's an easy position to be in because you see those big swings, but when not a lot is happening, and when it's on a bit of a slide here, it's okay because we get quite a bit of money to stay in the position. I think the overnight differentials is about 30 or 40 pips or so in Euromix or things like that. So it's a relatively easy granddaddy position to be in. So that's the other one that I'm still looking at today. I've spoken about those Swiss pairs. Ryan already showed it as well. 85.5 is really where we have to start to break for it to go higher. But then we are still going to have to wrestle in the longer term with this 88. But that's really music for later. For the time being, it's relatively stable. Even Swiss still a little bit better beat on the back of those sticky CPI numbers. And with that, Ryan, back over to you.
Thank you very much, mate. Good analysis as always. Yeah, I'm pretty much concurring with what Kay says about trading at the moment. I've still got my running positions: long euro sterling, long euro dollar, short dollar yuan, short dollar yen. So I'm just going to be managing those. I think I missed the opportunity to sell dollar yen at 146 on Friday. A bit slow to the mark on that one, but it just shows that the ranges are well in play, and that's what I'm going to be looking for, particularly for that one. Nimble, in and out, in and out. Right, on that note, it's all left for us to do is wish you a great week for the rest of the week. And Kay, for you have a good few days off.
Thank
you. I shall keep you entertained until K-Man is back. Have a great one, everybody, and we will see you all tomorrow. Cheers all.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.